Hey everyone, and welcome to The Explainer. Today, we are pulling back the curtain to uncover a massive Wall Street secret, one that's been hiding in plain sight right behind a major news headline. We're going to completely dismantle a very popular media narrative and show you the hidden mechanical gears that actually drive the stock market today. Let's get right into it.
Okay, let's dive into this. It's the ultimate logical disconnect, isn't it? I mean, when global conflict breaks out, common sense tells us that markets should naturally panic. But recently, we saw the exact opposite happen. We watched a raging bull market unfold right in the middle of severe geopolitical turmoil. So, why does that happen?
Well, to answer that, we've got to look at one truly explosive day on Wall Street, April 8th. The evening before, on April 7th, Donald Trump announced a ceasefire with Iran. And the very next morning, the market reacted with absolute ferocity. The S&P 500 closed up 2.5%, the Nasdaq climbed nearly 3%, and the Dow jumped over 300 points, literally marking its best day in almost a year. Meanwhile, over in the energy sector, Brent crude dropped 13.5%, and WTI crude fell a staggering 16%. That was its biggest single-day decline since April 2020. Now, traditional financial media took one look at those massive numbers and instantly pushed a really convenient narrative. They called it a relief rally. The markets were just celebrating peace, right? Well, there was a massive problem with that story. The ceasefire was actively falling apart in real time. We have hard data from Windward, which is a maritime intelligence firm that uses AI to cross-reference GPS signals with satellite imagery, and they showed a 96% decrease in shipping activity through the Strait of Hormuz compared to pre-war baselines. Seriously, by midday, only 5 outbound carriers were detected moving through the strait. The conflict was actually escalating, not ending. So how on earth can there be a relief rally based on world peace when there is absolutely no world peace? To solve this mystery, we have to trace the timeline back a bit and look at the market's breaking point. Let's set the stage. On February 28th, joint airstrikes were launched in the Middle East, and the Strait of Hormuz was shut down. By the time we hit the end of March, the S&P was down nearly 9%. We're talking about the worst 5-week losing streak in almost 4 years. And that brings us right to the April 7th ceasefire announcement. The market was already this incredibly tense, coiled spring of anxiety. What's really interesting about this slide is how hard data from Goldman Sachs' prime brokerage desk proves Wall Street was frankly panicking. They reported the largest first-quarter hedge fund selling in North America since April 2020. These funds were massively borrowing to amplify their bets, which pushed gross leverage over 300%, near an all-time high. And most importantly, short exposure to major macro ETFs like the SPY and QQQ hit levels we hadn't seen since the pandemic. The street was massively overleveraged and aggressively betting on a total crash. I mean, just listen to the sentiment on the street right before this rally. Commodity analyst Rory Johnston warned that if the global supply chain suffered a massive detonation, the shock would literally be too large for the system to handle. He said, and I quote, "We still need to shed 15 million barrels a day of global demand. We're talking depressionary." Everyone was universally terrified. Everyone was bearish. So, when the market suddenly pivoted on April 8th, it wasn't a bunch of humans celebrating peace. Actually, scratch that, it wasn't humans at all. It was a mechanical chain reaction. So, let's look at the first of 3 mechanical dominoes that actually caused this massive rally. Domino 1, the short squeeze. Let's walk through the exact mechanics of a margin call, just so we're all on the same page. When you short a stock, you're borrowing shares and selling them, betting the price will drop so you can buy them back cheaper later. But if the price goes up instead, say on the headline of a sudden ceasefire, your broker issues a margin call. You are forcefully made to buy back those shares at a higher price just to close your position. Now imagine thousands of overleveraged traders getting margin calls at the exact same time. That force buying pushes the price up even higher, which triggers more margin calls and even more buying. That explosive loop is a short squeeze. And on April 8th, with short exposure sitting at a multi-year high, that first domino fell incredibly hard. But the squeeze was only the beginning. For this next part, I want you to completely forget about human fundamentals and focus entirely on the machines. Which brings us to Domino 2, algorithmic trading. Specifically, we need to talk about CTAs, or commodity trading advisors. These are massive, systematic trading firms that run entirely on rules-based models. They don't sit around reading the morning news over coffee, and they certainly don't care about the nuances of Middle Eastern geopolitics. They trade purely mechanically. When a trend goes down, their algorithms automatically short the market. When a specific price trigger is hit on the way back up, their models violently flip from short to long. They are completely 100% on autopilot. So the crucial point here is the sheer jaw-dropping scale of what these algorithms did next. Going into the ceasefire, CTAs were sitting on a $30 billion net short position. Goldman Sachs estimated that if the market ticked up, these algorithms would mechanically need to buy back around $40 billion of equities. But the actual algorithmic buying spree blew right past that estimate. It hit $86 billion across just 5 trading sessions. According to Goldman, that is a top 5 buying speed print of all time. Think about that. We've got a short squeeze, and we've got algorithmic trend followers dumping $86 billion into the market. Now it's time to enter the hidden world of the options market.
Domino 3. Options hedging. Heading into this event, Spot Gamma, a leading financial data platform, flagged that the market was in a negative gamma regime. What does that mean? Simply put, options dealers have to keep their own books balanced, a state known as being delta neutral. When customers pile into options trades, the dealers on the other side are forced to hedge their own risk by buying or selling the underlying stock. In a negative gamma regime, this hedging becomes pro-cyclical. As the price goes up from the short squeeze and the algorithms we just talked about, dealers are blindly forced to buy more stock to balance their books, which pushes the price up further, forcing them to buy even more. A short squeeze, plus a systematic algorithmic flip, plus options dealer hedging. 3 mechanical dominoes falling one right after another. That is what really moved the markets. And zooming out, this exposes a permanent, structural change in how our stock market actually functions today. Welcome to the modern market machine. It's important to realize this wasn't just a one-off anomaly. We've seen this exact same movie play out across entirely different catalysts. Back in December 2018, markets were crashing, Jerome Powell uttered a single word, patient, and the Dow absolutely exploded for its first ever 1,000-point daily gain. Or how about August 2024? The Bank of Japan unwound the yen carry trade. The market dropped 12% in a day, and then mechanically bounced 10% the very next day. The headlines change, but these mechanical overreactions, they remain exactly the same. You're probably wondering, why does this keep happening? Well, 20 years ago, the market was dominated by human portfolio managers actually analyzing cash flows. Today, an incredible 63% of all U.S. stock funds are held by passive indexers. That is more than $13 trillion of blind money on autopilot. It doesn't read earnings reports, it doesn't care about product launches, it just blindly follows the index. And this brilliantly illustrates how passive investing mathematically traps the market. Because most of those passive funds are market cap weighted, the bigger a company gets, the more of it the funds are mechanically forced to buy. That is exactly why just 7 massive tech giants, the Magnificent Seven, now make up a full third of the S&P 500. A massive chunk of the entire stock market isn't being thoughtfully priced by human beings anymore. It's just receiving capital allocation by default. So, what about the remaining active managers? Well, the hedge fund industry has largely consolidated into a few giant multi-strategy mega funds, like Millennium and Citadel. These funds operate at 4 to 8 times leverage. They don't sit in a boardroom debating whether a war is officially over. They have strict drawdown limits. The moment those limits are hit, their systems blindly and immediately sell. And underpinning this whole shebang is the sheer overwhelming scale of the options market. Same-day expiration options now make up around 63% of all S&P trading. Get this, on peak days, we are seeing over $2 trillion of notional value, that's the total underlying amount controlled by these options, change hands in a single trading session. $2 trillion. Every single one of those trades forces a dealer on the other side to hedge in real time, which creates a giant instantaneous feedback loop of mechanical buying and selling. The old-school market of finding undervalued companies and holding them for the long term, it's largely been replaced by a giant feedback loop of algorithms, passive funds, and options dealers reacting to each other in milliseconds. The news headlines you read are often just narratives slapped on after the fact to rationalize these mechanical movements, which leaves us with one final, absolutely critical question to walk away with. If human fundamentals and real-world events no longer drive the market, who is really in control of your money? Thanks for joining me on this explainer, and remember to keep questioning the mechanics behind the headlines. See you next time.